If you've been selling options for a while and are looking for ways to take your profits to the next level, you're in the right place. In this video, we're going to be diving into 4 powerful adjustments that could supercharge your option selling game. Whether you're already familiar with covered calls and cash secured puts or just starting to feel confident with them, these tweaks will help you bridge the gap from beginner to intermediate and beyond. Let's get started. First up, cash secured puts. One of the biggest drawbacks of selling a cash secured put is the hefty amount of collateral you need to provide up front. Depending on the stock, it's not uncommon to need anywhere from $2,000, $13,000, $20,000, or even $60,000 if you're trading something like the SPY. And that's a lot of money tied up, just sitting there, not actively working for you. So here's my first adjustment. Add a tail to lower collateral requirements. Now I know what some of you might be thinking. Isn't that just a credit put spread? I already know about that, but hear me out. This setup is designed to be temporary. It gives you the flexibility while keeping your capital requirements lower until closer to expiration. Let's break this down with an example. Take SoFi, for instance. Pull open the option chain, and we're going to be doing a cash secured put, so let's go about a month out. And let's say that I wanted to sell the 15 strike put. I would get $98 for this. But I would have to also front $1,500 of buying power to enter this position for 30 days, the length of the contract. Well, if I didn't want to use that much money, I could simply just add a tail to lower the collateral amount. And here's how we can do that. Just go back to the option chain and switch to the buy and put tabs. We want to look for an extremely out of the money put option to buy against this. So if we look at the 10.5, we can see that this costs only $1. If we add that to our order form, we can view the summary and see that by adding this contract, we lowered our needed collateral to $450. That's freeing up $1,050 that can now be used elsewhere. We can actually look at an active similar position in my portfolio that's using this adjustment. Here, as I get closer to expiration, there are a few options. If both of these strikes are out of the money, I can just continue to wait and let everything expire. But if the short call is actually very close or in the money, I can actually sell the leg for most likely a profit and add back in the temporary collateral reduction of $1,000. Or I could just close the whole position if I'm wanting to avoid assignment. It's very similar to managing a cash secured put outright. But many traders really overlook this ability to use an out-of-the-money long put to offset margin requirements. And this is a collateral saving adjustment, which is appealing to all accounts, especially smaller accounts that don't want to tie up all their collateral. Just note that, of course, this is a more advanced strategy, so this will come with additional management. The other drawback with selling cash secured puts is locking in your max profit when the position is open. But there is actually a way to adjust a cash secured put where you lock in your minimum profit at open and can set a different max profit. This is the second adjustment, and fasten your seatbelt, buddy, because this one might blow your mind. Let's go back to the option chain and start as normal by selecting a put option that we would want to sell that's out of the money. Let's say the 14 strike put. This cash secured put has a max profit of $62, but let's make some adjustments. Back on the option chain, we actually could switch to the buy tab and select an at the money put to add to this position. This is now simply a debit put spread, but we can actually go in here and edit the ratio to adjust this to be a credit position by updating the positions we're selling to 2. Notice how this changes the total credit we receive up front. Now it's $26 instead of $62. This is actually now our minimum profit. Notice how the max profit has now increased to $126, which is more than double what it was originally with just the cash secured put. And because of this adjustment, our break-even is significantly lower in comparison. The cash secured put had a break-even of $13.38, but this trade has a break-even of $12.74. This is because we're actually using the premium from selling the puts to purchase a debit put spread to amplify our profits on the downside. Pretty wild. This is an amazing adjustment for stocks that you want to own because this strategy is actually catered to giving us the highest return at the short put strike. And as a secret insider bonus here, you could actually use the first adjustment that I recommended and add a tail here to lower the collateral even further. Look at this. A $279 max loss with $121 max profit. I know it was a lot so far, but pause the video, take a break, and if you're finding any of these tips helpful, please don't forget to like this video. It really helps the channel and it's completely free to subscribe. And dropping a comment really means a lot. Now let's take what we've just learned and apply it to covered calls. One of the biggest downsides of selling covered calls is missing out on the profits from big moves in the underlying stock. It's honestly one of the most frustrating things. You're selling covered calls to generate some nice, steady, passive income, and then the stock just brutally blasts through your strike price, leaving you watching from the sidelines while others get to enjoy the ride. But here's where my second adjustment comes in. And by the way, the official term for that strategy is called a front-end ratio credit put spread. And in this case, we're going to be using a front-end ratio credit call spread. This adjustment is also going to let us maximize the profit even when the stock starts to move aggressively upward. Let me show you how this works in action and why it become a game changer for your covered call strategy. Now, just like with the previous adjustments, we'll start by pulling open the option chain. Of course, for covered calls, you'll need to own at least 100 shares of the underlying stock. So we're assuming you already have that covered for this demonstration. Next, we're going to go about a month out in the expiration dates and select our preferred strike price for the covered call. Typically, this would be the strike where you're comfortable selling your shares if the stock hits or exceeds that level. Here, I'll pick the 141 strike. And we also are going to have to buy a call option that's closer to being in the money. I'll select the 136 strike here as that's the closest strike to being at the money. Now we will have to make the ratio adjustment to be able to turn this into a front-end ratio credit call spread. I know that's a mouthful, but the idea here is to hedge some of the opportunity costs from these big stock moves we mentioned earlier. So we will have to increase the amount that we're selling to 2. Hit done to return back to the order form, and we can see that our minimum credit, the credit we're receiving up front, is $305, and now our max profit potential is $805. Now let's address the trade-off. Sure, this adjustment means we're decreasing the amount of credit we receive up front, but here's the genius of it. If the stock makes a significant upward move, you'll actually stand to make a lot more, even if your short call gets exercised. This approach is perfect for traders who expect a moderate to large bullish move and don't want to cap their profits too early. Instead of feeling stuck with a low reward in a rising market, this adjustment gives you the flexibility and the potential for a much higher return. It transforms the traditional covered call, which is often seen as a capped and conservative strategy, into a more moderately bullish position that aligns better with market trends in a bull run. By making this adjustment, you're actually adding a layer of growth potential while still collecting credit up front. Now on to the last tip, and let me just say, if you've been following along this far, congratulations. You are leveling up your options trading game and moving more to becoming an advanced option trader. This final tip takes everything we've talked about with covered calls and flips the script. Imagine being able to benefit from these covered call strategies without ever needing to own 100 shares. Sounds great, right? Well, this adjustment is exactly that. Now, I'm not going to sugarcoat it. This strategy is the most complex one in the video, and I saved it for last for a reason. It does require active management, but here's the payoff. It significantly lowers your maximum risk while still maximizing your profit potential as the stock climbs. Let's break it down step by step by heading to the option chain. Unlike the other strategies we've covered, this one assumes you don't own 100 shares of the underlying. So for the first time in this video, we're going to be buying to open a position. We're going to start out by buying a leap option. So we want to go at least a year out, and from the time of this video's recording, that would be January 16th, 2026. Before we dive into the chain, we're going to need to adjust our metrics at the top right of the platform. For leap options, the two most important factors are volume and delta. And I'll tell you why in a second. So let's hop back over to the option chain. We're looking for a strike with a delta around 0.8. Why 0.8? Because this delta significantly reduces risk when we sell covered calls against us, giving us a strong foundation for the strategy. Here we can see the 80 strike has a delta of 0.85 and a higher volume compared to the other strikes around it, making it the perfect choice. So let's select this. Now that we've selected our leap option, we're ready to move to the closer expiration dates for selling calls. This is where you get to customize the strategy to fit your preferences. Personally, I prefer using weekly expirations as they allow for quicker adjustments and the opportunity to capture premium more frequently. So I'll select the December 27th date. Now we select the call we want to sell against this. I'm going to start with the 124 here, and then we just have to select a call to buy that's closer to being in the money than our short call. So for this case, I'll pick the 123. And just like before, we have to ensure that we edit our ratio to change the quantity that we're selling to open to 2. Now, when we look back at the P&L chart, it's going to look a little odd because we have multiple moving parts in the strategy. Keep in mind that this chart only reflects the profit and loss for the December 27th expiration date, which is the short call we sold. Here's the breakdown. Our maximum profit happens if the stock lands exactly at the strike price of the short call by expiration. That would be closing the entire position for a total profit of $553.72. The profit zone extends well beyond that, and we will still make money unless AMD skyrockets all the way up to $340.02 in the next week. This highlights the beauty of the strategy. It gives us room to profit even as the stock climbs, and our leap helps cushion the risk of a very big move. Now, if all of this feels a bit overwhelming, let me simplify it for you. What's really happening here is just a variation of the poor man's cover call strategy, but with an embedded debit call spread added to supercharge your profits on an upside move. That debit call spread is the secret sauce. It allows us to amplify gains at the stock rallies while still keeping our risk lower compared to owning the 100 shares outright. This strategy is perfect for traders with limited capital who still want exposure to significant upside moves while keeping their risk in check. It's a fantastic alternative to owning 100 shares outright, but it does come with its own considerations. One key factor is time decay on the leap option. As you continue to sell additional cover calls or front-end ratio credit call spreads, it's crucial to monitor how the leap's value changes over time. Proper management is essential, but when handled correctly, this adjustment brilliantly reduces your capital outlay and risk while maximizing your profit potential. In conclusion, let's wrap this up. We've covered 4 powerful adjustments to help you take your option selling game to the next level. Whether it's lowering collateral requirements with a tail on cash secured puts, maximizing assignment profits with front-end ratio spreads, boosting upside potential on covered calls, or leveraging leaps to lower risk and capital while staying in the profit zone. These strategies are designed to bridge the gap from beginner to intermediate trader. Remember, every adjustment comes with its own considerations, so always manage your trades carefully and stay flexible. If you found these tips helpful, don't forget to like, subscribe, and share your thoughts in the comments. Thanks for watching. Happy trading.